So let's use Black-Scholes model in a real world setting. The underlying asset or the underlying stock will be eBay stock. So example follows. Value the call option. This is the contract name. Actually, you already know how to decipher the contract name. Remember, you have the expiration date. This is the call option, and this is the exercise price. By using Black-Scholes as of the 10th of January 2025, will a rational investor buy this option? In order to duplicate the call, how much of a share of stock do you need to purchase and how much do you need to borrow? So let's look at the solution. You can, of course, use Yahoo Finance just for the eBay quotes. Just select on the options, just select the date. Remember, based on this contract name, actually the expiration date is 19th of September 2025. Just select calls. So we already identified call within the list shared on Yahoo Finance. And this is the, of course, the closing price for the eBay stock, the underlying asset. For the stock prices, actually remember Yahoo Finance doesn't allow you to download the historical stock prices, so you can use investing.com instead. Just select time frame monthly. So I looked at from the January 1st, 2019 to the 1st of January 2025. So as you will recall from the previous discussion in this chapter, the contract name, this eBay 250919C 00045000 provides hints as to what the expiration date and strike price are. The exercise price is 45 year and the call option expires on the 19th of September 2025. So these actually first 6 digits within the contract name after eBay, the ticker symbol. So the stock price of a share of eBay stock is $65.90 as of the 10th of January 2025. In order to calculate the exact number of dates from the 10th of January to the 19th of September, that is the expiration date, you can rely on the days function of Excel. We also need to determine the annual risk-free rate continuously compounded. So let us look at each variable we need to determine in order to use the Black-Scholes formula. The stock price S is 65.90. The exercise price is E is $45. The annual risk-free rate continuously compounded needs to be determined. Just as we did before, I will again use the info on Wall Street Journal. See the next slide. The annual yield on US 1-year Treasury bill is 4.223% on the 10th of January 2025. I need to convert this rate into a rate continuously compounded. Let us define R as the annual rate continuously compounded in the following equation. So 1 plus this is the annual yield or the yield on a US 1-year Treasury bill to the power of 1 because we are looking only for a single year should be equal to E to the power of R multiplied by 1. R is actually the value you are looking for, the annual interest rate continuously compounded. So take the natural logarithm of both sides, then ln this value should be equal to r multiplied by 1, but r multiplied by 1 should be equal to r. So then r will be equal to 4.136%. Or as a cross check, 1 plus r to the power of 1, r actually should be here the annual return on US 1-year Treasury bill should be equal to e to the power of, here I am just entering the continuously compounded risk-free rate, so r should be equal to this value, and actually it is equal to this value, 4.223. Also intuitively, the continuously compounded rate should be lower than the annually compounded rate, as compounding frequency is more in the continuous compounding, and a lower rate will be sufficient, so that in the end, both the annual rate and the continuously compounded rate will yield the same amount. Here, for example, US 1-year Treasury bill, this is the yield, I used this as the risk-free interest rate for 1 year from the Wall Street Journal. This is the link here. And then I converted this rate into a risk-free rate continuously compounded that will be used in the Black-Scholes formula. So the R we need in the Black-Scholes formula is 4.136%, the annual risk-free rate continuously compounded. And for you need to calculate time to expiration. I will use Excel's day function, so the term t in the Black-Scholes formula will be equal to first you need to calculate t, by the way, in terms of days. Remember, now was January 10th, 2025, and the expiration date was September 19th, 2025. Just use the days function, enter end date first, then the start date. Then Excel will actually render the days between these two dates. But be mindful of entering these date and start dates values in this fashion. So then 252 days divided by 365, 0.6904, because remember you need actually this number because t should be expressed in time in years to expiration date. So annual variance of the returns on the eBay stock, the last variable you need in the Black-Scholes formula. Remember, I actually pulled the data from investing.com, and actually it starts from the most recent date. I wanted to start from the oldest date, just use basic the sort function, sort by date, sort on sale values, and order oldest to newest. So now actually you start from the 1st of January 2019 and going through 2025. Then of course, remember, because I want to look at the annual returns, just use filter function and enter January, so that actually you will be looking on the stock prices on the first day of January in each of these years, starting from 2019 and ending in 2025. So you have these price values in here, and based on these price values, remember, you need to calculate annual returns, then take the average. Remember, in a longer fashion, you can calculate deviation from the mean, then you can take the square of these deviations. So it's the manual way to calculate the variance of the return on the stock. And here you will enter, remember, you will sum these deviation squares divided by the number of observations minus 1, or you can just use variance S, variance for the sample function of Excel. You have the annual returns, enter them here. You need to get the same result in these two different methods, as you will remember from the previous discussions. And also remember, the exercise price, the stock price T was already calculated, and by using days function. And remember, annual risk-free rate continuously compounded was this. So now you need to calculate D1 and D2. As you will see, all these parameters within these two equations. So first calculate D1 and D2, and then calculate ND1 and then D2. You can just use norm standard distribution function of Excel, or the norm dist function, which is the longer way. Then you can just use the Black-Scholes formula to calculate the price of the call. The amount borrowed, remember, in the Black-Scholes formula will be the second term of the Black-Scholes formula, and the amount borrowed will be $37.40. So the value of the call is calculated as $23.11 through the use of Black-Scholes formula. On the 10th of January 2025, the last traded price for the contract was $25.93. So the option may be overpriced, and a rational investor may not choose to purchase this contract. Nonetheless, given the volume and open interest numbers for the contract, the option contract doesn't appear to be much liquid, and this may affect its price. Furthermore, the variance of the return on the stock is prone to measurement errors, and I looked only at the returns for the last 6 years, thinking that more recent data will be more representative of the risk of the underlying stock. Recall that MD1 represents the fraction of a share of stock to be purchased to duplicate the call, and it is around 0.92. So one should buy 0.92 shares of eBay stock. The amount to be borrowed to duplicate the call is calculated as $37.40. This is a new website. You can also enter the variables and then you can calculate the value of the calls and puts. So I entered the values for my example. Remember the underlying price, the stock price, exercise price, days until expiration, interest rate. Actually, I don't know how actually this black box tool handles interest rates, whether you need to enter them uh, in annual rates or continuously compounded rates. So I entered the value I used. Dividend yield, also interesting, and I also entered the volatility here. So it actually gave me this value for the value of the call. Still close, but different from the value calculated through the Black-Scholes on slide 93. So it's a black box tool whose model I don't know. How is dividend yield incorporated into the Black-Scholes formula, for example? I entered the risk-free rate continuously compounded following the requirement of Black-Scholes. Is it so here? I also entered the yield on a 1-year US Treasury bill without converting it into the rate continuously compounded, and the change was really negligible. The call option, the price changed, but it was very similar to this value, very close to this value. So we don't know these things in this black box tool. So this is a peril of using such tools. The danger is greater, especially when you don't know the intuition behind Black-Scholes and option pricing. So use them only for the purposes of comparison. So you calculate a price through Black-Scholes, through your Excel spreadsheet, and then you can use this tool and compare your prices, how much they differ.